Warren Buffett. Most of the investors are familiar with this name, and many of them look to his quotes for inspiration. He is one of the most well-known and successful stock market investors on the planet. Since 1970, he has been the CEO and major shareholder of multinational conglomerate holding company Berkshire Hathaway and has amassed a fortune investing through this company. He follows a set of rules and values to make investment decisions, and his stock-picking strategy is well documented in his renowned investing quotes. Warren Buffett releases an open letter to Berkshire Hathaway stockholders every year. These letters have become an annual essential read in the investing world. In this video, we will discuss some of Warren Buffett's most well-known investment advice for investors. No matter how great the talent or effort, some things just take time. You can't produce a baby in 1 month by getting 9 women pregnant. We live in a world obsessed with speed, and we love to get things done quickly. Same goes with money and investments. Money doesn't grow overnight, and great things take time. It takes time for a valuable garden to flourish, and you'll have to be patient in order to achieve the desired outcomes. The majority of people fail in life simply because they are impatient. There are no shortcuts to wealth, no matter how smart you work. It takes time for a business to grow. If you want to become a billionaire, you need to become a millionaire first. Patience is vital to success, and you should put a lot of effort into mastering this skill. You can achieve big things with small actions that build up over time. This is not only true for money. The same concept applies to skills and health. It takes years of consistent effort. Be fearful when others are greedy. Be greedy when others are fearful. The stock market never moves in a straight line. It has ups and downs. Market movements are influenced by factors such as greed and fear. When stocks are performing well, people tend to become greedy. How long could you truly wait to jump in? If you witness stock after stock rise in value, and fattening the portfolio of investors who had already taken a risk. If you hear people saying buy the shares, you need to be fearful because the market fluctuates and it will crash again. That's completely fine. The other half of his phrase comes into play here. When everyone else is panicking because the market is down and a double dip recession is possible, the stock market will never recover, you know it's time to buy the shares and get greedy. We all know this isn't the case. Historically, what goes down must come up, which is why being greedy when others are fearful will help you thrive. Practically, being fearful when others are greedy and greedy when others are fearful is simple rule of stock, buying low and selling high. When stock prices are low, you should buy them, and when they are high, you should sell them. Not following the herd mentality in stock will surely pay off. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Mr. Buffett is a value investor and has always prioritized quality over quantity. He prefers to purchase high-quality stocks and buy stock of wonderful companies. It's fine if you have to pay extra for high-quality stocks. If it's not a good company, don't buy its stock just because it's cheap. High-quality companies are often worth the price tag. Because a company with a strong competitive advantage is more likely to make money in the long run, whereas bargain bin companies often produce bargain bin results. Selecting a good stock from the vast universe of listed stocks can be tough for any investor. A bad decision might bring your portfolio to the ground. There are few strategies which an investor should consider while selecting the stocks, such as business model, promoters, management's and board of directors' background, revenue, and EBITDA. Rule number 1, never lose money. Rule number 2, never forget rule number 1. This first principle isn't meant to suggest that you can't ever lose money. Rather, it emphasizes the importance of capital preservation over all other considerations when allocating funds. You are looking to make profit in the market, and one of the best ways to do that is to avoid losing money. Mr. Buffett is merely expressing the mindset that a smart investor should have when making financial decisions. Don't be frivolous by failing to do your homework. Don't gamble and never go into financial decisions believing it is acceptable to lose money. It is important to know what you and your family need and do not need. Anything above that should be set aside for savings and investing, as capital preservation will always be the most significant aspect in accumulating wealth. If you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. As an investor, one of the many questions you may have is how long you should hold a stock and when you should sell it. Well, the number of years you wish to keep your stocks depends entirely on your investment style and approach. It is better for fundamental investors to hold stocks for the long term, which means at least a few months and preferably few years. Holding stocks for short periods of time is more akin to speculating than investing, and it increases your chances of losing money in the long run. Mr. Buffett says in this quote that the average investor's path to success is not through short-term investments on certain stocks, even if their growth appears to be a foregone conclusion. As an investor, your goal should be to find high-quality companies and hold them for as long as possible while avoiding being sidetracked or diverted from your goals by short-term volatility.